So just as a brief introduction here, today our guest speaker is Paul. Paul serves as the co-head of fixed income for Madison Scottsdale Investments, and he is the chief executive officer. Paul has been working in the financial services industry since 1989, and he joined Madison back in 2005. He earned his BA in accounting from Michigan State University, and Paul is a member at Madison of the Investment Strategy Committee. For just a little bit of background on what Madison Scottsdale Investments is, Madison is an insurance investment management company based out of Scottsdale, Arizona. They develop customized investment strategies for their clients based on financial, operational, and risk tolerance needs. So now that you have that background on what Madison is and who Paul is, I'll give Paul a chance to give us some background on who he is and tell us a little bit about himself.
Yeah, so thank you. Thanks everyone for being up early. Yeah, I've been in the investment business about 30 years. I went to Michigan State as an accountant, found out real quickly that that was not really what I was meant to do. I joined a small investment management company at the time called Duff & Phelps in Chicago. And they were primarily large cap equities and investment grade fixed income. And I joined their analyst team on the fixed income side and then kind of grew there. I took my CFA shortly after joining the firm. The firm was very specific about having your CFA in order to be part of the investment teams. And so I took my CFA, ended up running the fixed income area at Duff & Phelps. We were bought by an insurance company and merged into their, what I like to call general accounts management. And so I moved up to Madison, Wisconsin, and joined another insurance company up here briefly before I ended up here at Madison Investments. And I've been here just a little over 15 years. Started as the head of fixed income and now as co-head of fixed income and CEO.
Gotcha. Definitely a lengthy career and definitely some time spent at Madison. So Paul, I gave obviously just a brief description of what Madison is based off information that I know, but can you go into a little bit more detail about what Madison Investments is? What does the company do?
Sure. So Madison Investments is a 100% employee-owned firm. We've got about $18.5 billion under management. We are what we call a multi-boutique or a multi-strategy firm. And to just provide a little color on that, basically what we've done is we've grown both organically and inorganically, and we have added a number of investment capabilities over the years. And we structured it in such a way where we have multiple investment teams, both here, and one in Scottsdale, one in Toronto. And what we've done is the multi-boutique strategy really is born out of what we're trying to do is allow all the investment teams to provide good investment performance, focus on investment performance, and then we have centralized business management, centralized risk management, and centralized business development so that they can stay focused. Because what you find over a long period of time is that usually investment people aren't great at running all of the other functions and they just want to manage money. And so what we've done over the years is we've added a number of teams in Madison. Scottsdale, obviously in Scottsdale, Arizona, is our insurance specialist. So we have 4 teams right now. We have a U.S. equity team, a fixed income team, which Madison Scottsdale is part of. We have a multi-asset solution. So think about target date, target risk, kind of multi-assets where we're the advisor and kind of overlay our investment management, asset allocation strategies, and then use our internal strategies and or external strategies as well. And then we have an international equity, kind of growth equity, large cap in Toronto. In addition to kind of multi-strategy, we also have what we call multi-distribution. So our distribution is really 3 primary areas. The first is what I would call intermediary. And by that, I mean, in your local area, if you see a JP Morgan or you go to Morgan Stanley or Schwab or a number of these different offices, the advisor will work with the individual investor, and then Madison could be selected as either the large cap, the mid cap, the high grade fixed income, all depending on kind of how they're building out the investment strategy for that individual. So the firm was really founded on that intermediary basis. We also have very solid distribution in the insurance side. Again, I'm sure you talked to Ann Jeannette, but Ann Jeannette runs the business development over at Madison Scottsdale. And what they're doing is they're working with small to medium-sized insurance companies as kind of the outsourced chief investment officer and helping them develop kind of investment strategies that fit the business of that insurance company. And then we also have quite a bit of money in the credit union channels, either with the members of the credit unions or what we call the executives of the credit unions. So like if you're an executive of a big credit union, you've got a pension plan, you've got all these special benefits, and it's usually a fairly large piece of money, and it's more institutional. And so we go direct both to the insurance and the credit unions as well. And then the final piece of our business is what we call the private client group. It is local investors, local retail people who come to Madison because they want Madison's investment capabilities. And we have, for lack of a better word, a independent RIA that works directly with those local clients to help them develop good long-term plans and work with them on investment and on their investment portfolios.
Gotcha.
So we kind of do quite a bit of a lot of things. So
it seems that way. A lot of moving parts, obviously, more so than I was able to pick up on when first going through the website. It's very interesting. The question I have as a follow-up to that, when talking about your private client group and just your clients at large, is who are your clients, or what type of clients do you serve? It's insurance clients, right? And what does that mean?
Yeah, so we've got a number of clients. The foundation of the firm was built on our retail clients. So again, folks that have investable assets, that are, I guess I'd call them, fairly wealthy. I mean, again, we've structured strategies down to a minimum of 100,000. So we have what I would call strategies that are sold directly through, the JP Morgans, Morgan Stanleys, the Schwabs, and what have you. And so those are what I call the retail clients. And then we have, what I'd call institutional clients. They would be foundations, endowments, insurance companies, credit unions, and what I guess I would call just plain direct, more institutional industry. We've got a trailer company. We've got a company that runs a bunch of farms that is local. So more on the institutional, less retail, and we're very diversified with regards to not only our clients, but just the geographics. The majority of our retail clients are not in Madison or the Midwest. The majority of them are on the coast. So we've got a pretty nationally recognized brand with regards to Madison.
And when it comes to some of your more high net worth clients or just more valuable clients, what is the amount of assets that you manage for those clients, or what are some of those more high?
Yeah, so we got about 18.4 billion, and roughly I'd say 9 to 10 billion is what I call truly retail clients. So we're about 60-40 retail versus what I'd call more institutional, more corporation endowments, things of that nature.
Wow. Next question I have for you is, you at Madison serve as the head of fixed income, or the co-head of fixed income. Can you give us some insight into what the head of fixed income is, what that means, and what your responsibilities are in that position?
Sure. So, like I said, when I was 36, I became head of fixed income at Duff & Phelps. And then when I joined Madison, I was head of fixed income at Madison up until about a year ago when I became a co-head fixed income. And the reason that we have the co-label on there now is that I'm in the process of working with what I would call the person that will eventually take over the group if everything works out. So my role right now is different than the role when I started. When I started, I was responsible for the entire management of the fixed income team. That team was a 9-person team. We managed treasuries, U.S. agencies, investment grade corporate bonds, and agency mortgage-backed securities. So we have individuals that specialize in each area. My job was to oversee that staff, that research function, and then work with the more senior members on developing fixed income strategies and then implementing them across all of the different types of portfolios that we have. We have all kinds of different, from corporate only to government only. And so I was responsible at the end of the day for the performance with client retention, with development of fixed income strategy, and then managing the fixed income.
Gotcha. And another one of your roles at Madison is that you're a member of the investment strategy committee. Can you walk us through what that committee looks like? How often you convene and what you do within that committee?
Yeah. So when you go to a multi-boutique or a multi-strategy organization, what you want to do is you want to allow each of the investment teams to have the freedom to manage their investment strategies, to make the buy-sell decisions, to make the sector decisions, to pick the kind of companies or the kind of asset classes that they want to pick. And the investment strategy committee really operates, I would say, really with 4 main functions. Number one is to provide general oversight and make sure that the performance being generated is competitive and the performance that's being generated is consistent with our investment philosophy and process. So that would be the first kind of goal. The second is to make sure that the portfolio management teams understand the risks that are embedded in the portfolio, as it not only relates to their philosophy and process, but the peers out there. Because not only do you want to understand what the index looks like, but the peers look like, and you want to make sure you're providing consistent performance and, quite frankly, doing what you say you're going to do. And so that would be the second function. The third is what I call general risk management oversight, making sure that somebody is not, way out over their skis. I mean, we're a pretty conservative investment manager, so we want to make sure that, somebody's not buying very, very risky positions in the portfolios or outsized positions in the portfolio. So a little bit of risk oversight. And then I would say the last is what I would call business. And that is understanding, kind of if they have the right people working with them, do they need additional resources? Do they need additional tools? And then, are there different products that they would like to launch or feel that they should be launching that their strategy would fit really well? And so it's really not dictating performance or dictating how somebody is positioned, but it's making sure that they're staying in their lane and they're doing what we tell our clients we're supposed to be doing.
The next question I have for you, Paul, is, on the Madison Investment website, you emphasize the importance of enterprise risk management. And while that's something that I'm sure all business students here learn about in one class or another, it's something that they probably don't conceptually think of and apply it to a firm like Madison Investment. So I wanted you to talk about what enterprise risk management is and how it plays a role in what you do at Madison in portfolio.
Sure. So I will first start by saying I'm an investment guy and not a professional risk management. I have a person in charge of that very function. I do sit on the committee. It's what I would say is business risk. So think of things like making sure that we've got all of our compliance procedures in place. We have a generator in case the building gets wiped out. We've got cybersecurity. We've got vendor audits going on. We have system audits going on at all the time. It's basically making sure that any kind of business risk that attacks Madison, COVID's a great example. that we have policies and procedures in place so that we do not have a disruption in our business, because markets continue to stay open regardless of COVID or a tornado or flooding or any of the above. And risk management, making sure that we are, from a continuation of business where we need to be. In addition to that, we have a brokerage committee to make sure that our brokerage allocation is correct. That committee will come in and make a presentation to the risk management committee. We have general office oversight, so that the various offices have to have systems and documentation in place that is showing that they are following, the rules and the procedures that are put into place. And that report goes up to the risk management committee. So I think of the risk management committee as, it's kind of funny. It's become more important than the investment capabilities themselves, because again, you could be the greatest investor in the world, but if a tornado wipes out your building and you can't operate anymore, you're not doing right by your clients. So it is definitely a very, very, not only important part of what we do, but it is extremely important with regards to obtaining what we call shelf space and be able to develop these large relationships at some of these big entities. So if you think about it, like a JP Morgan's risk management team will come on site and will check out all of our policies and procedures over a full day, sometimes 2 days, to make sure that we have all of the systems and processes in place and know how to operate in a way that is going to be, very highly ethical and not be interrupted by some event, if you will.
Gotcha. Thank you, even though that's not your specialty, of course, for, enlightening us on, some more details about it. The next question I have for you is that, Madison claims to, quote, develop a custom portfolio solution for your insurance partners or the people and companies that you manage assets for. I wanted to ask, are there strong similarities between the portfolios that you create for your clients, or are they, mostly different?
Yeah, so it's a very customized approach. Like I said, Madison really has, I guess, what I would call, 2 different ways of investing, or 3 different ways of investing capital. The first is at the product level. So think of it as investment grade corporate bonds or large cap equities, mid cap equities. We have a portfolio that we apply to every single client that comes through the door. So if somebody wants our large cap, they get our large cap. If they want our investment grade fixed income, they get our investment grade fixed income product. The insurance area, the credit union area, the multi-asset area, the private client area is much different. It is more of a customized approach. And insurance companies in general, obviously, they have different business risks. They have different state risks. They have different, balance sheets, different income statements. And so our approach to managing insurance companies' assets is very customized. Our team has a lot of years with regards to working with insurance companies or working at insurance companies. And therefore, they take their abilities and go in and actually sit alongside the executive team at the insurance company and develop a customized approach based on their risk tolerance, the state regs, their balance sheets, what their business is doing, the premiums that they're writing. So everything is very customized at that level. But like I said, we also have the, what I call the canned products or strategies that we offer. And obviously, if you offer a strategy, you can offer that at a much lower fee than more of a customized approach, because there's a lot more resources and it's not nearly as scalable.
Gotcha. And Paul, although you did highlight some of it, can you describe an example of a company and a very unique portfolio suggestion that Madison may give to that company based on their needs, whether it be like risk or some other factor?
Sure. So we have a large religious organization that is very fortunate that they're well overfunded in their endowment. So they have their cash flow is significantly more than their spending policy. And so we sat down with them and went through kind of that, what I call surplus, and developed a risky strategy, not a really risky, but a riskier strategy than they were using in order to generate a lot more income, and basically working with them to understand that their return expectation can be a lot higher, which means their risk tolerance should be a lot higher because of the massive surplus they were running over and above what their spending policy was going to be, or even projected to be if you put in, more aggressive inflation numbers. So that's what I mean by we kind of work with folks. Like, you'll see portfolios that are way too risky for what they're trying to accomplish. You'll find portfolios that are not risky enough. You'll find people who are trying to generate X performance or X return, and their risk tolerance don't line up with their performance expectations. So it's really working with them to understand both their risk tolerance and their performance expectations, and really tying that together to develop a multi-asset, program for them so that they can meet their financial needs.
Thank you for that, Paul. It's a great example. It's a really interesting one. And the next question I have for you is, on your website, it says that your primary focus at Madison is on preservation of capital and surplus. And I just wanted you to walk through what that means to our members, the preservation of capital and specifically like surplus.
Yeah, so we trademarked the brand Participate and Protect. All of our branded strategies and products at Madison follow the same general philosophy, and that is we are very long-term investors. What we're trying to do is generate good long-term results and protect capital at the same time. And we define that as kind of the up-down capture ratio. So we're trying to capture about 90% of the up market while strictly controlling the risk on the downside. And so we're shooting for the downside capture to be 70. And if you can get 90% of the up markets and 70% of the down markets, over time you have very attractive results. And in addition to that, what you do is you protect capital in times of volatility and strife. So when I was talking a little bit about our brand, if you went into some of these big wires, the Morgan Stanleys, the JP Morgans, the RBC Wealth, some of these offices, if you said, well, I want to generate some decent long-term performance. I've already created a bunch of wealth, but I want to make sure I'm protecting capital on the downside. 80% of the people that know Madison will say, well, you want Madison then to run your money. So it's a really ingrained in our investment philosophy, in all of the processes, in all of our products and strategies that we have at Madison. And it's no different on the insurance side. We have the capability for insurance companies to add high yield and, some, mid cap, small cap. But what really, I think, brings us to the table is the fact that, we are a very conservative manager, and we will err on the side of protecting capital and will not chase that extra return like a lot of managers. And that's just something that, when you're in the investment area, you have to get in your own mind. I mean, some people just want to, go and get as much possible performance in every single market as they can. And that's great, but you also subject yourself to an enormous amount of volatility, the standard deviation of your returns are massive. And if you're comfortable with that, that's a fine way to manage money. But we opt for these kind of steady wins the race, consistently. We want to make sure our standard deviation of returns are, less than the indices that we're up against. And we want to make sure that our multi-asset solutions or discussions result in less volatility rather than more.
Thank you for that, Paul. I think that was a really interesting explanation, especially the point of trying to catch 90% of the up markets and 70% of the down markets, and in doing so, being able to beat the market over time. And I think that in answering that question, you kind of answered the next question that I have for you, in that when people want a conservative manager that aims for the preservation of their capital, they usually refer those people or those companies to Madison. But my question is, how does Madison primarily find new clients?
Yeah, so again, I think it's, it depends on what channel that you're in. As far as the intermediary or retail channel, we really have what I call a two-pronged approach. The first is we have what's called strategic accounts. And so we have a few individuals that work directly with the research areas at these large companies. So they will work with what they call the research and due diligence teams at Morgan Stanley or JP Morgan or RBC. And if those research analysts, much like we're analysts, decide that they like Madison, they like Madison's strategies, they like Madison's performance, their philosophy, and then they do the on-site due diligence with regards to risk management, like we talked about, you can get approved and put on what we call the shelf or availability list, if you will, for all of the advisors and all the offices to use. And in addition to that, you can actually get a placement where if an advisor is just going to use a model, so they're going to use an aggressive model or a conservative model or a middle of the road model, you can actually have what's called the sleeves in each one of those models. So our conservative large cap would be a small sleeve in the aggressive, but maybe a large sleeve in the conservative. So we can get a lot of money through just that relationship and of the research analyst in New York, oftentimes, and few in Minneapolis and one in San Fran. So that's one way, and that's primarily on the retail side. The other portion of that is that we do have what we call wholesalers. We don't have a lot, but we do have people that are out and about, meeting with what we call the top 100 advisors. Just because we are on the shelf, we do have availability there, and they go out and talk about Madison or bring a portfolio manager in or what have you. So that's kind of how we grow the retail assets. On the credit union side, we have a dedicated salesperson that goes to the larger credit unions and works with them with regards to what we call executive benefits, again, their pension plan or their retirement plan, their all of these different types of benefits that they get that are funded by the credit union is managed by the credit union. They usually don't have that capability, and so they'll hire us to manage that multi-asset kind of solution, if you will. And then we have the insurance person that's in charge of insurance development right there. So maybe Angela will tell you what she does on the how she gets the insurance companies on board.
That would be great. Yeah, Ann Jeannette, if you could follow up with that.
Thanks for putting me on the spot, Paul, but I appreciate the opportunity. Yeah, so on the institutional side, it's a little bit of a different animal. As you all may know, the institutional space, insurance institutional side of the business is quite a vast and large space investment-wise. Our focus tends to be on those insurance companies that don't have in-house expertise. The all states of the world and some of those larger insurance companies that you might be familiar with their names, the Geico's. Most of the time they have an in-house chief investment officer and a team. And so our focus tends to be on those small to mid-sized companies that don't have the budget or the wherewithal to bear those expenses of doing that in-house. And we focus on basically being what we call outsourced CIO. Their outsourced chief investment officer is what Madison Scottsdale serves as. I think the other change that we're seeing in the industry, I mentioned that most of the large insurers maintain those expertise in-house, but we've seen over the last 10 years, but 5 years in particular, a little bit of a sea change where CIOs are saying, well, I don't have the depth of bench, or there's something in an alternative strategy that I don't want to hire somebody to bring in. And so they'll outsource that particular, where they've decided to make an asset allocation. they'll go out and look for a manager that has a specialty in that particular sector or asset class. And we're seeing more and more of that opportunity. It really started out being kind of these alternative type solutions, but I think we've seen a migration to where CIOs are saying, hey, I want a horse race here. Even if I manage some of my assets in-house, I know this firm over here does a good job in tax exempts, and I want to give them a sliver of our assets under management, and let's see who can win the race and do the best work here. So we're a little bit all over the place, but I would say our sweet spot for Madison Scottsdale tends to be in those insurance companies that are maybe on the low end 25 million, but on the high end up to 600 million. And we run the gamut of anything from traditional commercial line insurers that are property and casualty, so homeowners, auto, those kind of things. We have health insurance. And then something that we've been focusing a lot, where there's been a lot of great opportunities lately, is in the captive insurance space. And we could talk for hours about that, but what I'll say is it's a niche part of the insurance industry that's really growing, and it's basically self-insurance. And so a lot of big corporations, particularly S&P 500 companies, have figured out that it's in my best interest, instead of giving my premium away to this large commercial insurance company, to bear some of that risk myself. And in doing so, not only am I saving money, but I'm controlling a lot of my risk. And so it's a big enterprise risk management sea change that we've seen. And I would say that COVID this year has been something that has, in and of itself, made big giant corporations realize where they thought they had exposure for cover for exposure to business interruption, they really didn't. And you're going to be seeing a lot of that in the news right now, particularly in the insurance space, of who's going to foot the bill for these big corporations that have had to shut down. And so there's a battle. It's going all the way to Capitol Hill right now. And I wouldn't be surprised if you didn't see something in the Supreme Court case determining who's going to bear that risk, because companies thought they had coverage from the insurance companies, and it gets all down to the semantics of things. And so as a result of COVID, you've seen a lot of companies say, okay, well, from here on out, I know that the insurance company is not going to cover me for business interruption, and we don't know how long COVID's going to last. So now I'm going to self-insure that. So that's been a big exponential growth in the insurance industry, which ultimately brings more assets to bear to manage. As those premiums grow and they retain those liabilities, they're going to invest those monies to kind of cover the spread there. So lots of interesting things on what is traditionally called the boring insurance side of investments. It's actually a lot. It's, I think, one of the most exciting places that you could get involved in investments.
Well, Ann Jeannette, I'm very glad you got involved, because that it entailed a lot of interesting information. One thing that I thought was especially interesting is how, rather than companies having their own CIO position, which many of them do, they decide to outsource that to Madison, and you basically take that role of the company, and you have now become in essence their CIO through managing their assets. But I just wanted to make sure I understood this part correctly, which sounded very interesting. Some companies will take a portion of their investments and give those investments to you to manage, and they'll compare that to what their CIO does with the rest of their assets. And whichever one basically does better, you said it's a horse race, right? They might end up, they'll give you more assets if you outperform them, and vice versa. Is that
well, that's the idea. I mean, I think a lot of it is just diversification of strategies. And to clarify, when we have a scenario like that where we're getting, if you consider the investment portfolio this giant pie, and we're getting a piece of that pie to oversee, that's where you would tend to have the management of those assets, rather than being in our Scottsdale office. That's where Paul's located up in Madison. The team up there that's really oriented to total return and kind of that upside downside capture. In Scottsdale, the OCIO is a more integrative approach. It's a little bit different. We're not solely focused on total return. We certainly, it's one of our primary focal points and drivers, but it's not the only thing we think about. And so you tend to see a more pure total return focus when it's just you're getting a particular sleeve or piece of that pie. And it does, oftentimes it can create greater asset flow into your strategy if you're outperforming the other managers. But it's not just competing with their in-house. Oftentimes they may not even have in-house. They might have an internal CIO, but then that person becomes the manager of the external manager. So it's a horse race against other managers that are not necessarily at that insurance company.
Okay, thank you for that, Ann Jeannette. And Paul, back to you. A question that I wanted to ask is, how does Madison earn its income? Is it through commission on the earnings of the assets that you manage, or through other means?
Yeah, so we have what's called an investment advisory fee. So we don't have a commission-based schedule, and so we'll charge different basis points, if you will, based on the strategy. Like I mentioned earlier on, when it's what I call the canned, or it's a product and it's not a strategy, you typically have a lower basis point fee. Whereas if it's more of a customized, multi-asset, specialized solution, like the large religious organization I was talking about, the basis points is a bit higher because there's specialized advice and reporting and what have you. And so the way Madison has chosen to operate is we charge one fee regardless of whether it's a multi-asset or whether it's a single strategy. But all of the different ways that we deliver performance have an associated fee attached to it. It is not a performance-based fee, so it's very consistent whether we outperform or underperform, and we are a fiduciary, and so having that variable fee, having that commission, we always feel doesn't align you correctly with your fiduciary responsibility. So it's a basis point fee depending on what the product strategy or the actual advice that's going to be given.
And Paul, you serve as the co-head of fixed income, so I wanted to make this question more relevant to you. But I want to ask how recent economic changes, obviously mostly in light of the pandemic, maybe in part because of the presidential election, but you're more long-term, so I'm not sure about that, have influenced your fixed income strategy, if at all?
Yeah, so the way I would look at it is that because the term structure of interest rates are so low, you do have to shift the way that you're trying to add additional return. This market is very difficult to add return slowly on income. When you have higher rates and you have wider spreads, buying non-treasury assets, holding a lot of credit, holding a lot of mortgage-backed securities, trying to out-income the index is a great strategy and a great approach. In addition to that, you can buy longer and longer bonds when there's more yield associated with the market. And so therefore, you can get income into the portfolio, and historically speaking, that extra income generated typically will provide you with an advantage from a total return standpoint. With interest rates so low, with credit spreads so tight, with mortgages spreads so tight, now you really have to focus on hitting singles. And by that, I mean, moving up and down the yield curve, swapping different corporate bonds up and down the yield curve, trying to just add singles here and there to generate return because you're just not going to get enough out of the income portion now. And so the biggest change that we're seeing to our portfolios that are total return oriented is turnover is a bit higher because you can't get the doubles and the triples that you could get in other markets. You really got to, kind of turn the portfolio over a bit more. We're not a high turnover place to begin with. And because we're not charging a commission, there's not a direct, impact to the end client. But, I'll give you a great example. When you came out of 2008 during the financial crisis, you could buy a whole bunch of corporate bonds at very, very wide, attractive levels and just leave them in place for 5 or 6 years and outperform the benchmark. There are times when, the 10-year treasury is at 4, 5, 6%. You can buy a lot more 10-year treasuries. And as rates decline, you get a lot of positive price action. Now everything's very rich and very low yielding. And so you really got to protect now, and you really have to just look to hit singles rather than try to, get big, long general themes put into the portfolio, because rates are likely, I mean, you saw it today, there's a little bit of whisper of the vaccines getting close, and, you know, long bond was off over 2 points, and that's a significant negative performance on one day. So you just got to be really, really careful, because we don't feel there's a lot of ways that rates can go a ton lower here, but they can definitely go a lot higher. And at the same time, the indexes that we're against are getting longer and longer, because corporate bonds are getting longer and longer, because if you were a corporation, why would you not issue really long bonds right now? And you're at generational low rates. I mean, if you can borrow money at 2% for 10 years or 15 years or 30 years in some cases, why would you not do that? And so the corporate bond index is getting longer, which is part of the market. In addition, everybody's refining their mortgage. So every time you get a 4% 30-year fix down to a 3%, that index gets longer. You know, the government continues to issue longer bonds. So the index itself is getting longer and forcing people into taking more and more credit risk, more and more interest rate risk at a time. It's very aggressively priced. So you just got to be really careful, and again, make sure that you're, you know, doing swaps along the curve and keeping your risk very manageable, because you'll get a better opportunity to enter some of these riskier sectors of the market at some point.
Well, thank you. That was some really interesting insight. The follow-up question I have, which is not just focused on fixed income strategy in a moment, but more kind of broadly, is could you explain the basics of fixed income strategies? And for members, it says on the Madison website, this includes core bond, government, corporate, government, and tax efficient as kind of like those main categories.
Yeah, so we run a number of different fixed income strategies here. The core strategy is investment grade, and it is indexed against the aggregate index. So it has more agency mortgages, treasuries, U.S. agencies, and investment grade corporate bonds of a specific size. So every month the index obviously gets reconstituted, you know, based on the eligibility, but it is a full gamut. It goes from 0 to 30 years. And so that's what I would call a core strategy. Another big strategy we have here is what's called the intermediate corporate government corporate strategy, and that invests in governments, investment grade corporates, but limits the duration at 10 years. And that is probably one of our best selling strategies, because if you look at the long index versus the intermediate index, you generate about 90% of your return on the intermediate index versus the long, with almost half the risk. So it's really a good risk adjusted way to add bonds to your portfolio, especially given kind of what's going on with regards to interest rates and the level of manipulation by the Fed. And then the tax advantage strategy is another fairly big strategy, and that is for retail clients who don't have a ton of money and want both a tax-free or muni portfolio, and they want treasuries and agencies and corporates. So we can kind of move through, you know, all of the different sectors and include the muni sector in there in order to add additional value. And we can take those accounts at a much more lower level. So we do have high yield bonds here. It's a very small portion. We add a little bit to our core strategy in places where people want a little more risk because they need a little more income. But in general, we're primarily investment grade, solely investment grade, and concentrate really in that intermediate maturity structure.
And Paul, given that you have been in the financial services industry since 1989, although there may be a few exceptions, you have been working in this industry for longer than any of us have been alive. And for that reason,
you made me feel old.
No, I should make you feel experienced. The question I have to ask you is, what advice do you have for a student looking to get involved in the financial services industry?
Well, a couple of things. At the very high level, first of all, is you always have to remember that everything you do at every moment of the day is for your clients. This isn't about your firm. It isn't about how much money you personally can make. It isn't about how much money your company can make. It is about the end clients. When you enter this industry, the people who succeed understand that you're a steward of capital. You need to be ethical, you need to be honest, and you have to do continuously what's in the right interest of the client, even if it's not in your best interest or your firm's best interest. So that's the advice I always give. The reason I think that people like Ann Jeannette and myself have, had such good long careers is that we know this is other people's money and we have to do the right thing for them and for the clients first and foremost. So that's number one. I think the second thing is you need to decide whether you want to be in the investment management business or the investment advisory business. The investment management business, I always like to say that's the manufacturing. You're making the widget. You're creating the performance. You're generating the results. The investment advisory business is you're giving advice. You're allowing others, typically speaking, to create the widget, to create the investment performance. And what you're providing is a plan, counsel, asset allocation. Those are two really big decisions because it's very rare you find a firm like Madison that does both. Now they're out there, but typically speaking, your career, your jumping off spot, you kind of have to have a feel for kind of where you want to go, whether you want to be on the private client side or you want to be on the investment management side. So that would be, another, piece of advice. If you become a portfolio manager and you become an investment expert, oftentimes those people, and I can say this because I work with those people, and this was never me, but I do work with them. You get so engrossed in picking the right company and creating the great performance and making sure that your philosophy is correct and your process is correct and you got the right risk management. You also have to remember that you have to have the ability to talk with clients and work with your distribution partners in order to raise assets, because at the end of the day, there are 9 fixed income guys that come through the room. Ann Jeannette sits at a table with 6 other people that claim they're better than we are, right? And sometimes they are, sometimes they're not. But at the end of the day, they're going to select Ann Jeannette or myself because it's a tie and they believe and they have a relationship and have developed a relationship with you. And so you can't just solely be about the performance. You have to make sure that you understand that servicing and working with clients is an important part of the job. And then there's always a little bit of selling you have to do. You have to sell yourself. You have to sell your firm. You have to sell your strategy. And so again, understanding that you've got to be well-rounded, and you have to be able to not only make good investment decisions, but also make clients feel comfortable and work with your distribution team to bring in new clients. So that would be number one, and that'd be the biggest portion. And then, again, if you wake up every day and you say the client always comes first, you're going to be fine. I mean, I can't stress that.
Thank you for that, Paul. I really appreciate that. Next question that I have is, if there is such a thing, I know that it says on your website that your team averages 30 years of experience, so maybe it takes some time to get involved, but how could a student get involved at Madison? Like, for instance, are there any jobs, or do you offer any internships for undergraduate students?
Yeah, so we do have a nice intern program here. Most of our interns are coming through the applied program at the University of Wisconsin. Marquette has a program called AIMS, which is in Milwaukee. And then we have a couple of Chicago firms that are kind of feeding into us right now. And that would be Northwestern's finance area and the University of Chicago. Again, I think maybe Ange and I can offline, but, I'm glad to try to help you guys get, into that pipeline. It's mainly, as you can tell, in the Midwest, and it's for no other reason that it's pretty easy for us to reach out and get those folks in here. They're right down the street. Chicago's 2 hours from here, and Milwaukee's an hour from here. And plus, UW's applied programs, one of the best in the country. So we've got a lot of availability, if you will. We typically hire probably 4 interns a year. During the COVID here, we haven't really done much, but typically speaking, we usually do 4 a year. And we usually have our candidates selected by January, February. So it's a pretty early process. The majority of it comes on the equity side, I will say. We usually only have 1 on the fixed. The majority of the rest of it's on the equity side. So that'd be number 1. Number 2 is, obviously LinkedIn, which is where you sent me the note before I even heard from Ann Jeannette. So Bloomberg job. I don't know if you guys probably got Bloomberg. So you type in job, you can see every intern, every job that anybody's posted on Bloomberg. I mean, that's for myself, that's a great way to look for really good talent without, hiring a search firm to go out and find it. And then the CFA website. And so that's another important area where you can find not only internship availability, but also, entry-level positions in the investment area.
It looks like somebody just asked in the chat, and I'll let them ask this question just before we get to the end.
Right, just so you know, I've got 8 minutes and I got to get on a management call.
Okay, absolutely. Right. So, you know what, for that reason, let's just go to member questions that members may have. The first one from Jeremiah is, what type of majors do you look for? Jobs, internships, that kind of stuff.
Yeah, so generally financial, emphasis in finance, emphasis in economics, and I have an accounting background, so you do see the accountants that have a minor in finance. So those would be the kind of 3 areas. And I don't know, I mean, I think that's the majority of it. We usually won't hire somebody that's, doesn't at least have a finance minor in there somewhere, or at least talk to them initially.
Are there any other questions? You can enter those in the chat or unmute yourself and ask questions that you have.
I think the other thing I would add to the question you asked Paul earlier about, advice on getting into this field is I happen to be uniquely in the insurance investment management, which everyone I talk to that's of my generation has come in through this kind of backdoor, obscure way in insurance. And I think just be open-minded to think about, it's not always what it appears to be on the surface, and you go to a wirehouse and what have you. I ended up in investments purely because I was hired in through the insurance channel, and started out actually through the short-term cash treasury management aspect for an insurance company and the investment accounting for that insurance company. And that was the very beginning stage. Right out of, I got really lucky and grew through these opportunities, but through a part of the industry that you wouldn't normally think of. And one other thing that if you're wanting to network and kind of get involved and think about, what avenue do I want to take? The insurance industry right now, it has really put a lot of emphasis and focus on the next gen. It's a big, big push for them. They have a huge talent gap. And because of that, they are definitely focusing on bringing, whether you're an actuary major, that's another area that you can get involved in, is a big thing. That the whole data sciences, I think, even just in general across investments. But a lot of the universities now are offering insurance programs where that didn't used to be on the radar. And so I would explore those. There's here in Tempe, if COVID, doesn't ruin it for us, there'll be a captive insurance conference that welcomes students. If you want to get in touch with me, I can get you the details for that. But that's another way that you can kind of explore and get a lay of the land of, what opportunities do lie, in investments or in the finance arena that you wouldn't traditionally think of. I'm going to go work for, Merrill Lynch or JP Morgan Chase, what have you. I know that's how I used to think of it, and kind of just accidentally fell into a much bigger world that I didn't even know existed.
Yeah, I came from the accounting side, so that's a very good point. I was hired at Duff and Phelps to do the performance analytical work, which was primarily a accounting function, and that's kind of how I came through. Do you want me to run through the few of these questions I see here real quick?
That would be great if you could.
Yeah. So do you find simulation modeling and regression analysis is helpful in your strategy? Yes, especially on the fixed income side. We model all kinds of different portfolios and stress test them, and regression of the mean, all of that kind of stuff is very, very, very important in developing, especially a multi-asset solution or working directly with the client with regards to risk tolerance. So yes, the answer to that is definitely yes. Do we use quant trading strategies or plan on getting into it? Most of the quantitative work that we do here is more screening. And by that, I mean, we take an investable universe and use some quantitative inputs in order to screen that universe down to a more manageable level. But as far as program trading and more quant strategies, we do not do that here at Madison. It doesn't fit our brand very well, so I don't anticipate us going down that direction. Can you relay any advice regarding raising capital in terms of how flexible you should be with new clients? How much should you change your strategy or product? Well, that one's a tough one. You never want to give up your core investment beliefs, or you never want to kind of do something that you're not capable of doing. But like I tell, and this is why the PMs have got to be client people. I told somebody this the other day. You can have the greatest performance and the best investment strategy known to mankind. But at the end of the day, if I can't raise assets as a businessman, it's kind of irrelevant. So there has to be a very good, I think, marriage of investment capabilities, investment strategies, with an eye towards, obviously, you need to raise capital in order to create your business. So as long as the potential client and the investment firm or your entity is on the same page, and you feel comfortable executing that, what I'd call maybe one-off strategy, then I think that's totally fine. How far is it for a non-finance, but what does STEM mean? Maybe I don't understand that. STEM major? You know what that is, Ange?
Yeah, so
yeah.
I wouldn't say that it would be that difficult for you to translate that. I think that, if you're looking at, that gives you, you're going to give you that broad background. But I think it's really just getting out and connecting with people, and demonstrating that, hey, I have, number one, a background in understanding numbers and the various aspects of math, because there is a lot of math that goes into some of this stuff, and science, technology, and all of that. It particularly if you're an equity analyst, you're going to be, that is something that you could use, particularly if you have an interest in a unique field, that could open a door for you to become an analyst, for example, for a particular strategy. And one thing that comes to mind as we're talking about this, and I know Paul needs to go here in a second, but ESG investing is huge right now. Environmental sustainability and governance. That's the big thing, the direction that people are going as we look at investments for the future. And so that all plays into that, right? Understanding how these companies work. So.
Yeah, you guys, I've got to jump. I think Ange could stay a few more minutes. I was going to say that the head of our, that runs our entire large cap core portfolio has an engineering background. He did not have a finance background. He came, but we actually got two people, and one of our senior analysts all have an engineering background. So.
Well, Paul,
you guys,
thank
sorry,
you for
I
your time.
got to jump on this management call right now, but I thank you, and I'm glad to follow up at any time with you guys.
Thank you, Paul. Appreciate it.
That's material. So one thing I could do, go back to 6 for that and change this one to 18. much deeper.
Ann Jeannette,
Yes.
I am very glad that you joined because you have answered some questions I don't think we would have got answers to otherwise, and given us insight into things that I think are useful for many of our members. There are a few questions left here in the chat, and I think that, given that you've been able to answer many of them, you would be able to answer a few more of them. One of them is, do you have any PhD like students working for you at that level of academia, and how do you use them, if at all?
So the really quick answer on that one is at Madison we do not. I wouldn't. It's certainly something that as a firm we could be open to, but we just haven't found that as an opportunity at this point. But it would seem to me that would be somewhere more on our analytics. If we were more of a quant shop, I could see, which Paul has mentioned we're not. I could see that coming into play more, but in our case, that it's not something that we've explored.
Okay. Thank you for that.
And the other area where you often see that, where there's some PhD type, would be perhaps an in-house economist, and we don't have that structure in our firm. We have our in-house views and then rely on external economic research providers and whatnot that we follow and aggregate and assimilate into our perspectives.
Okay, thank you for that, Ann Jeannette. And a question that Travis Berkner asks, I believe is how you pronounce it, is when you're hiring people for any position, an internship job, whatever, would you prefer a candidate that has background in fintech, financial technology, or is that not, too much of a factor?
I would say for us right now, it's not too much of a factor as Madison, the firm, but one area where I will tell you in the particular niche that Madison Scottsdale's in, the insurance niche, if you've got a fintech background, you should definitely be checking the insurance industry right now. It is huge. Not only from a business model perspective, in terms of how they're underwriting their liabilities, but just every aspect of the insurance business model is really starting to be blown up and reinvented by fintech. And it's quite interesting to watch unfold. I mean, you all, you hear the progressive commercials and that kind of thing, but that doesn't really, I don't think, show what's really going on behind the scenes and where they're using telematics or you're buying your insurance pay per use kind of structures, insurance sharing, that kind of thing, where, and that's, I mentioned the captive industry. That's another area where fintech is making a big explosive move, and even cryptocurrency is coming into the insurance arena as well. So, and I don't think that, I know when I was younger, as an ASU alumnus, it wasn't something that was on my radar, and back in the day, I think they had one course on insurance, and that was it. So they're starting to develop specific programs now, but the insurance industry is huge. And but as it relates to the fintech question, I think that is a big place that I would look at based on what I'm seeing and experiencing out there in the industry.
And Ann Jeannette, I want to give you the credit where it's due. I've not introduced you yet because I didn't know with certainty if you were going to be joining the call, if it was just going to be Paul. But for everyone who is still here, a brief introduction to Ann Jeannette when she talks about coming from the insurance space. She knows quite a lot. Brief introduction is from the website. With over 28 years of experience in the investment management arenas of several insurance companies, Ann Jeannette brings a valuable understanding of the unique statutory, operational, and investment and accounting considerations particular to our insurance clients in the industry, being Madison, of course. Prior to joining Madison Scottsdale in 1995, she directed the investment accounting department and managed short-term investments for a large insurance group. Ann Jeannette holds a BS in finance from the great Arizona State University. So, that's right. Ann Jeannette, if you just have 1 or 2 minutes left, I do want to ask you, can you talk about your professional experience in the financial services industry, how you found this way to take your insurance, background and get involved at Madison and do what you do?
Well, as I kind of touched on earlier, it was actually purely not by design, but purely by accident. I can't stress enough at your age to get out and network. It really is who you know, and places that you wouldn't think about networking. Don't focus solely on, I'm going to go to this, event that's, with this investment group, because you'd be shocked at the ways that you can kind of get where you want to go or learn about opportunities that you would have never thought of. And that's what happened to me. I happened to stumble across an entry-level opportunity my last year in college. Basically started out as an assistant portfolio manager / kind of analyst type person, collecting all of the information that was needed to make investment decisions. And that was with at that time, a savings and loan institution that happened to own several insurance companies. And through that, I was contacted by the CFO of the insurance group and said, hey, we have this next level of position, and we need somebody to oversee our internal short-term cash investing and do our investment accounting, it's a little bit different than straight GAAP accounting. There's statutory regulations. And so through that channel, I was able to just start and work my way through, and eventually landed this opportunity at Madison Scottsdale. I've been here a long time, and but I think the insurance space is one that just holds great promise and opportunity for young people. And it's kind of, for lack of a better description, I think it's got a reputation for the boring old man's industry, and it's exactly the opposite.
Well, thank you for that. Jeremiah asked, when you were answering that question, mentioning short-term investments, he said, what types of short-term investments?
Certainly, there's commercial paper, money market accounts, short U.S. Treasury type securities, things where you're just generally investing within a 1-year time horizon. So the breadth of that universe is not as wide as you would be doing this true, in most cases for longer term investments. But there are some unique animals in that industry. Auction rate preferreds were a big thing for a while, and those ended up getting in trouble because people were chasing yield back in the day. But they do have a lot of derivative product even in the short arena of things. But Paul mentioned I'm on the business development side for Madison Scottsdale. For the majority of my career, I was on the trading portfolio management side until the last number of years. But so there's a lot of different places that you could take this, coming into investments, and it truly is, as much as it can be kind of a technical, analytic type business, it is a relationship business at the end of the day, because you have to build that trust and confidence with people.
Thank you for that. A question that was just asked in the chat is, do you have any insights or advice for individual retail traders?
Oh, I guess the thing there would be is if that's, the area that you want to focus on, what I just mentioned about relationships, that to me, that is the arena that epitomizes, kind of building that relationship and trust with people. Certainly if you can get an internship with one of the wirehouses and work your way through, they have a lot of programs for people that are just starting out, but usually to kind of grow through that channel and stay in that channel, you're developing what they call a book of business. And to grow that book, it requires a lot of work and time and effort and that relationship building to grow the assets. And then you see what you might read about this from time to time, but people grow by moving. They generally aren't staying at one wirehouse the whole time. They're taking that book and somebody, taking it from Wells Fargo maybe over to Merrill Lynch or JP Morgan. And that revenue, the idea is you're taking your book and the revenue that comes with that along with you. And so it's kind of a little bit of a game that you play, moving from one place to the other and getting paid upfront sometimes on what that revenue stream brings to whatever entity is hiring you. But that's, I would say probably trying to get an internship and just being a kind of a people person, I think is really important in that aspect of the business.
And the last question I want to ask you, because I know you probably have to get going, is, one of your focuses is relationship management, I would guess mostly in respect to your insurance partners, which is what Madison Investments primarily is. Can you talk about relationship management, some of the things that you've learned throughout your career, what makes for good relationship management?
Well, I think, Paul touched on this a little bit earlier. I think, just being honest with people, even if it's not in your best interest from a bottom line perspective, if it's going to, you sometimes just have to own up if you're, people want to know they can trust you, especially when it comes to their money, whether it's individuals or institutions, and we're acting as fiduciaries. So I think that trust building is probably the core foundation of that. But I think the other part of it is through that, the relationship management and business development really go hand in hand, because most of our growth in the insurance channel is coming through referrals of existing clients. And that's one of your biggest sources for asset growth. The other is building relationships where you don't necessarily have clients. And in my particular space, it's really connecting with what I call those COIs, those center of influence people that, the best example I can give you in the captive space, there's the administrative aspect of running a captive insurance company that's usually outsourced, and that's with what's called a captive manager. Those people are the gatekeepers and the decision makers for these companies. I mentioned an S&P 500 company could be a large, really robust organization with, thousands of employees, but they don't have any specialty in-house personnel that know how to run an insurance company, nor do they want to become an insurance company. So they outsource that to what's called a captive manager. Those captive managers are centers of influence who I want to get to know in growing our business, because they're the ones that are determining and the gatekeepers for if their client, the S&P 500 company, says, hey, we want somebody to invest our investments for the captive insurance company, who would you recommend? Well, if they don't know who Madison Scottsdale is, then that's not a good thing. And so it's really getting out there and developing those relationships with the people that are not necessarily the end client, but the people that are advising the end client or protecting the end client. So I think it's a process. You have to kind of think outside of the box a lot, but the relationship management aspect for me is the critical piece of the business development part. You've got to develop those relationships, and then you'll see the success on the growth side.
Well, Ann Jeannette, truly can't thank you enough for staying with us throughout this whole meeting and giving us the insights that you have. I can say on behalf of all members that it has been a useful and interesting and engaging event. And I'm very glad that you were able to join. Hopefully you'll be able to join our event on Wednesday as well, if possible, but totally up to you. In the chat, people are expressing their appreciation. They're very happy.
See that. Thank you, everyone. We appreciate the time, and I would just encourage you. I'll get back with you on some of the opportunities in the insurance space. That there is a conference that's coming up here, and as I said, the insurance industry is really looking to grow the next gen. So to me, that's an explosive space for opportunities, investment and kind of satellite related. So I'll get that information to you, Lewis, and we can connect some people up.
Okay. Thank you for that, Ann Jeannette. I appreciate it. All right, everyone. Well, that wraps up this meeting.